everybody, it's Tom and Henry. We're coming from our respective homes or pseudo homes. I'm at my actual home in Maryland. Tom's in Texas at his house. But we wanted to talk a little bit about the recent volatility and frame it in terms of historical precedents and historical outcomes and so forth. So I'll turn it over to Tom for the moment and talk about markets.
Great. Thanks, Henry. Yeah, as Henry mentioned, as I'm sure you're probably aware, we've been getting a few calls lately as over the last a couple of weeks, we've seen some pullback in the markets, most notably in the tech sector. Matter of fact, this morning, I believe the NASDAQ from its all-time high earlier this year is off about 10%, which is actually what's considered a correction. So you'll hear these terms, corrections and bear markets at times. And just to bring you up to speed, a correction is typically when a market drops from its high to its low by 10%. If a market goes down 20% or more, it's considered to be in a bear market. And of course, the market started off this year, the NASDAQ, the S&P, the Dow hitting highs, and the NASDAQ especially. So basically, the NASDAQ just started to turn negative here this week. And so we thought we'd try to give you a little perspective on that and how, our correction's normal and so on and so forth. So one of the things I wanted to talk about here, we'll pull up a chart in a second here, but basically, corrections are very normal. They typically happen about once every 16 months, right? The last time we really had a 10% pullback was, of course, when COVID hit last year, and we saw the markets drop over 30% at that time. And of course, it ended up that the market being forward-looking, it ended up being a good year altogether. But it was pretty scary last year in the first quarter when we saw stocks drop as precipitously as we have. And one of the reasons recently why we're seeing a drop in the market is basically because we're starting to see interest rates go up. And what's happening is while the Federal Reserve has come out and basically said, we're going to keep rates low, and they kind of control the federal funds rate, the Federal Reserve doesn't really control the bond market. It's an animal all unto itself. And so one of the things that's happened is with the vaccines coming, what we're seeing is we're starting to see a reopening of the economy. We knew it was coming, and it's starting to happen pretty quick here. And all of the economists now are basically increasing their estimates of how strong the economy will be. We're getting GDP forecasts of 7%, 8%. I've even heard one person say 10%. Now that's kind of an outlier. But the bottom line is if we get anywhere near any of these numbers that the economists are predicting, we're going to have the strongest GDP growth in probably, close to 40 years. So what happens with that is, when the markets were not doing well, interest rates ended up going down, and the Federal Reserve cut interest rates. So back before COVID hit, around January of 2020, the 10-year Treasury bond, and that's kind of what's used as a benchmark for interest rates, was about around 1.8%. And then toward the zenith, after the market sold off in the depths of a market correction, interest rates on the 10-year bond went down to about 0.55. So you're only talking about 1.3%, but if you think about it, that's a pretty big percentage drop in interest rates. And based on that, that's one of the lowest interest rates we've ever, we've basically the lowest 10-year we've ever had in our country's history. And so, again, they keep interest rates low to try to stimulate the economy in hopes of, people will lend, businesses will invest, and, the economy will get back going. And what happens when interest rates go down or low like that, it actually ends up pushing up risk assets meaning stocks, meaning real estate. And we've all seen it, right? The market miraculously came back last year, ended up on a great note. And we've all know what's happening with real estate. Maryland, I'm here in Texas. You've got houses that are going, unseen with many offers on them. So risk assets have done very, very well. Well, like normal, what happens is there's always a pendulum, right? So sometimes the pendulum swings too much one way and too much the other way. And what happened is the market has run up quite a bit and, probably a little overstretched on the upside. And so now that the economy's picking up, what's happening is interest rates have gone up. And I mentioned they were as low as 0.55. Well, today, and this is Friday afternoon, they actually had one this morning hit about little over 1.6%, which again doesn't sound like a high rate, but coming from where it was, that's a big adjustment again. The unemployment numbers came out today showing that the economy, that the unemployment was better than what economists had expected. So as we've been saying is, we believe that, there's a ton of pent up demand. The economy is going to recover. And because of that, we're seeing interest rates naturally float up a bit. And the market's digesting this. So the areas that typically get hit the most are the ones that did the best last year. So technology, as we all know, did really well. We're starting to see those stocks take some pretty good hits over the last couple of weeks. Okay. And let me put this in perspective for you. Henry, can you pull that chart up? So the chart that Henry is pulling up here, I'm just going back 5 years to give you an example. And over the last 5 years, since 2015, these are showing the corrections we've had. Now, this in this instance is showing you the S&P 500, and you can see that we had 5 different ones, including the big drop last year of at least 10%. And then it shows you how long before it recovered or basically got back to where it was before. So, we actually think that this pullback right now is very similar to both the 2015-16 pullback and also the later one in 2018. Because what happened back then is 2015-16, interest rates, again, were starting to go up. And they were going up a little bit quicker than anticipated. So we had seen a sell-off very similar to what we're seeing right now. And then even more so, 2018, we had an up year that year until around the last 6 weeks of the year. So especially in December, took a big drop in the market in 2018. And what was happening back then? If anybody remembers, the Federal Reserve Chairman Powell started raising interest rates, and he raised them several times. And so what happened is the market had you can see a big sell-off. Now that one lasted, you can see 95 days, a little over 3 months and so forth. But then obviously the markets came back. 2019 was a banner year. The S&P was up over 30%. And of course, last year, even after having a 33% drop, the S&P ended up over 18. I think it was up over 18% last year. So we think these are kind of similar. And so what we're saying is, and thank you, Henry, for the chart. What we're basically saying is that we certainly think, the markets could continue to sell off a little bit, okay, over the next couple of weeks. But we actually think that inflation is not a real problem. And that's the point of interest rates going up, the worry of inflation. Prices going up. We're seeing oil going up. At the gas pump, you can see that. Housing prices are going up. And we think it's kind of transitory. And what we mean by that is that there's so many factors out there, a little longer term, that we think are deflationary, which will not allow us to get into an out of control inflationary spiral. Those deflationary things basically have been the premise of the last couple of years of some of the things we've been talking about. All the technology, the electric vehicles that are coming out, soon to be self-driving vehicles, artificial intelligence, the breakthroughs in genomics, which basically allowed us to actually have a vaccine so quickly for the COVID-19 virus. So these things, typically when we get these disruptions, that they have a tendency to be deflationary. And we think that those forces are certainly greater than the inflationary forces, though they will spike. And right now we feel that we're in the spike. So, as we have said, previously in our kickoffs, and talking to some clients here over the last couple of weeks, the next few weeks could continue to be choppy, and I wouldn't be surprised if we saw a little bit more of a sell-off. We again believe if you close your eyes and wake up the end of the year, we think the markets will be higher. Honestly, I think they'll be higher than what we started the year with, so I think it'll be a positive year. Though I think the bond market, as we mentioned before, because interest rates are going up, the bond market could suffer a loss, especially the longer-term bonds could be likely negative for the year. So, we hadn't been in touch with you for a couple months. We wanted to just touch base to let you know what our thoughts are. We think that, certainly if we do get even more of a pullback, great buying opportunity for those of you who have additional funds, possibly not sure, a little concerned with the market. These are the times when we get like this, which typically end up being the best investment opportunities. If you'd have put money in anywhere near those lows that I showed you over the last 5 years, you'd have been very handsomely rewarding. We think that's going to happen again this year. So with that said, Henry, you have any other commentary?
No, I would just add, the issue with interest rates is that when you look at global markets, the biggest market in the world is the currency market. And right behind it is the bond market. And then way behind it is the stock market. So it gives you, I think it gives perspective that it's hard for the Federal Reserve or any global central bank to truly control interest rates. And a lot of what we've seen the last few days, or last 2 days, yesterday and today, is because Chairman of the Fed, Powell, spoke at a Wall Street Journal conference yesterday and really didn't talk down much about, I'm gonna control interest rates and those kind of things, because as Tom alluded to, they see it as transitory. You're obviously going to see inflation because people are coming back and spending money and pushing prices, and the economy's opening back up. And so the it word right now is transitory bouts of inflation while we open back up, but not long term. So, and that's more or less because the Fed can attempt to control interest rates, but it's only through their purchasing of bonds and selling of bonds that they can juggle interest rates.
Great. So, the takeaway here, that we want our clients to have is we have, for all of our clients, we have you in models. We make changes periodically, and to basically, stick by our plans, stay the course. When you see these fluctuations and you see your accounts go down, it can be easily emotional to say, hey, I'm worried. Should I, I want to sell, but our experience, 30 plus years in the business and stuff, is that typically you need to stay by your plan. And while there's no guarantee, as we said, of future performance, it's always worked out for us, and I believe it's going to work out again for us in the not too distant future. So if any of you have any questions, want to talk about your specific situation, of course, give us a call, and we're happy to go over your portfolio, your holdings, and go into as much depth as you'd like. So with that, see you later from Austin.
See you from Maryland. Have a good day, everybody.
Have a good day.